Most ETF investors are holding the wrong fund. They just do not know it yet. Not because they made a bad decision, because 5 myths about ETFs are so widely repeated that most investors accept them as facts and make expensive decisions on the basis of them. The myth is the mistake. This is what NTM told us, the technical layer behind the philosophy. In the next 8 minutes, 5 ETF myths, what most people believe, what the data actually shows, and what to do instead. By the end, one of these will change how you look at your own portfolio. Your brain hears diversified and translates it as safe. Those are not the same word. An ETF holding 500 companies is diversified. It is not safe. Diversification reduces the risk that one company destroys your portfolio. It does not reduce the risk that all 500 companies fall together, which is exactly what happens in a crash. This is the behavioral trap Mike Petrie talks about on Nobody Told Mike. The gap between how an investment feels and what it actually does. ETFs feel safer than individual stocks because they hold many things. That feeling is real. The safety it implies is not. Diversified and safe, not the same word. Never were. Every ETF myth in this episode is rooted in that confusion. The vehicle feels safer than it is because it holds many things, not one thing. The brain rewards that feeling with false confidence. Myth 1. ETFs are risk-free. The most dangerous myth, and the most common. An ETF is a vehicle, not an insurance policy. The vehicle determines how you own assets. It does not change what those assets do. An S&P 500 ETF holds 500 of the largest U.S. companies. When those companies fall, the ETF falls with them. In February and March 2020, the S&P 500 dropped 34% in 33 days. Every S&P 500 ETF holder lost 34% in 33 days. The ETF did exactly what it was supposed to do. It tracked the index. The index fell. The ETF fell. Mike Petrie watched Big Four consulting clients call their ETF portfolios safe going into 2020. They lost 34% in 5 weeks. The ETF worked perfectly. That was the problem. According to Vanguard Research, equity ETFs have experienced drawdowns of 30% or more in every major market cycle since their introduction in 1993. The vehicle changes nothing about market risk. The truth: ETF investing carries full market risk. A diversified ETF reduces company-specific risk. It does not reduce market risk. Those are different things. Mike Petrie's portfolio on Nobody Told Mike accounts for this explicitly. The 10% bond allocation in his Stage 3 portfolio exists precisely because equities, including ETFs, carry full downside exposure. Myth 2. Leveraged ETFs are just bigger ETFs. This myth costs investors money every time it is believed. A 2 times leveraged ETF does not return twice the index over time. It returns twice the daily movement of the index. That distinction destroys returns over longer periods through a mechanism called volatility decay. Here is a simple example. An index rises 10% on day 1. A 2 times leveraged ETF rises 20%. On day 2, the index falls 10%. A 2 times leveraged ETF falls 20%. The index is now at 99, down 1% overall. The 2 times leveraged ETF is now at 96, down 4%. Not twice the loss, 4 times the loss. In 2009, the U.S. Securities and Exchange Commission issued a specific investor alert warning that leveraged ETFs held longer than 1 trading session almost always produce returns significantly different, and usually worse, than a multiple of the underlying index. Leveraged ETFs are short-term trading instruments. They are not ETF investing scaled up. They are a completely different product. Myth 3. All ETFs tracking the same index are identical to investors. Both buy an S&P 500 ETF. One is in Europe. One is in the U.S. Over 20 years, one ends up with significantly more money, despite tracking the exact same index. The difference? Domicile. The European investor holding a U.S.-listed ETF like SPY pays 30% withholding tax on U.S. dividends. The same investor holding an Irish-domiciled UCITS ETF like VUSA pays 15%. the result of the Ireland-US tax treaty. That 15% gap on dividend income, compounded over 20 years on a large portfolio, is a meaningful sum, not because of a different index, because of a different wrapper. Beyond domicile, TER, differences between funds tracking the same index, replication method, physical versus synthetic, and tracking error all mean that two ETFs with the same name on the label can produce meaningfully different outcomes. Covered in depth by Mike Petrie in episode 5 of What NTM Told Us. The short version: always check the domicile, the TER, and the replication method. Never assume identical index means identical product. If any of these has just changed how you see your portfolio, hit like. It helps more investors find exactly this kind of breakdown. Myth 4. ETFs never close. ETF providers close funds regularly. When an ETF is unprofitable, too small, too niche, too few investors, the provider liquidates it. Investors receive the net asset value of their holdings at the time of closure. The money comes back. But two problems arise. First, tax. In most European countries, a forced sale is a taxable event. If the ETF has grown in value since purchase, the closure triggers a capital gains tax liability, whether or not the investor wanted to sell. Second, timing. Markets may be at a low point when the closure is forced. The investor receives fair value, but fair value at the wrong time. According to S&P Global data, approximately 150 to 200 ETFs are liquidated globally every year. The probability of holding one of these is low, but not zero. The risk is real and almost never discussed. The protection: choose ETFs with significant assets under management, typically above 500 million euros, from established providers. Small niche ETFs carry meaningfully higher closure risk. Myth 5. You can buy ETFs at any price, at any time. ETFs trade throughout the day like stocks. That flexibility is real. But it creates a myth that the price you pay is always a fair reflection of what you are buying. Two problems with ETF pricing that most investors never check. The first is the spread, the difference between the buy price and the sell price at any given moment. At market open, spreads are typically wider. Market makers are still calibrating prices against the underlying assets. A wide spread means paying more to buy and receiving less to sell than the true value of the holdings. The second is the premium or discount to NAV, the net asset value of the underlying holdings. During volatile market periods, ETF prices can trade significantly above or below the true value of what they hold. During the March 2020 crash, some bond ETFs traded at discounts of 5 to 10% below NAV, meaning investors who sold during the panic received less than the actual value of the bonds inside the fund. The simple fix: buy mid-session on calm market days. Avoid market opens. Avoid volatile days. The price difference is usually small, but for large purchases, it matters. 5 myths, all widely believed, all quietly costing investors money. ETFs are not risk-free. They carry full market risk. Leveraged ETFs are not scaled-up ETFs. They are a different product with a different decay mechanism. Two ETFs tracking the same index are not identical. Domicile, TER, and replication method all matter. ETFs do close, low probability, real consequence. And ETF prices are not always fair. Spread and NAV premium matter, especially on large purchases. At the start of this episode, one of these was going to change how you look at your portfolio. Myth 3 was the one, wasn't it? Two ETFs, same index, different domicile, 15% difference on every dividend, compounding silently for 20 years. Nobody told you that. Mike Petrie covers the philosophy behind these decisions on Nobody Told Mike. This is the technical layer, the detail behind every choice. The reframe worth taking with you. An ETF is a vehicle, not a destination, not a guarantee, a vehicle. What you put in it and when still matters. Screenshot that. Because the myth that the vehicle makes the decision safe is the most expensive belief in ETF investing? Here is the question for the comments. Which of these 5 myths did you believe before watching? And has it changed anything about how you see your portfolio right now? If this breakdown clicked for you, subscribe here for more NTM explainers and watch Mike explain the full ETF story himself. Nobody told Mike. Link below.